Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Symbotic.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So, let's get into the analysis.
Yeah, let's do it.
We are talking about a really fascinating high-growth company. It's operating right at the convergence of industrial AI, advanced robotics.
In supply chain infrastructure.
Exactly. Symbotic is right in the middle of this massive $50 billion plus market for warehouse automation.
And this isn't some niche industry, right? This is about redesigning the whole spine of global commerce.
It really is.
I mean, you have these two huge macro tailwinds just colliding. First, there's the pressure from e-commerce for instant fulfillment. And at the same time, you've got these persistent structural labor shortages hitting the logistics sector.
Everywhere.
So companies basically have to automate. They needed to do it yesterday.
Precisely. And Symbotic's whole proposition is that they've built the proprietary AI and robotics platform to solve this very problem.
So they're not just selling a piece of equipment.
No, they're selling a whole system that revolutionizes distribution centers.
Yeah.
It's an intelligent approach, moving away from all those archaic manual processes.
And you can really see that reflected in the top line numbers.
Oh, absolutely.
Let's talk about those numbers because they are, frankly, staggering. They show the incredible momentum this company has.
They do.
For the full fiscal year 2024, revenue hit $1,822 million.
Which is a jaw-dropping 55% year-over-year increase.
55%. I mean, it's not just growth, it's accelerating growth. And at a huge scale.
And you have to contextualize that. Delivering that kind of growth when you're already pushing toward $2 billion in annual revenue, that shows massive market penetration.
And the ability to actually execute on these huge deployment contracts.
Right. And if you zoom in, Q4 of fiscal 24 came in at $577 million. That's a 47% jump year over year.
The year-over-year stuff is essential, but for me, especially in this volatile market, it's the sequential growth that signals real confidence.
Clean execution.
Exactly. The latest reported quarter, Q4 fiscal 25, revenue hit $618 million. That's a 7% sequential increase.
And that 7% jump coming after such strong results is a clear signal. It tells the market that any operational uncertainty is being managed.
Right. It means demand is translating directly into quarter-over-quarter delivery.
And delivery is key. We saw management guide Q1 of fiscal 25 revenue between $495 and $515 million.
And they have a history of hitting those numbers.
They do, consistently executing within or meeting their guidance. That builds crucial management credibility, especially in a field this complex.
Okay, absolutely. So let's pivot to profitability. This is where it gets a bit more nuanced.
It is. Symbotic is a growth story, but it's also maturing, and we have to separate the adjusted figures from the GAAP figures to really get it.
Right, that's the challenge, isn't it? On paper, full year fiscal 24 adjusted EBITDA was $96 million.
Sounds great.
It does. It sounds cash generative. But what's the practical difference for you, the listener? Why is this distinction so important here?
It's the difference between operational health and statutory accounting. Adjusted EBITDA, it excludes certain non-cash expenses, mainly stock-based compensation, or SBC.
Okay.
So that $96 million tells us that the underlying business model, the cost of goods, materials, direct expenses, is fundamentally sound. It's cash positive.
So if the business is generating that much cash from its operations, why is it still reporting a net loss under GAAP?
Because SBC is a real cost to shareholders through dilution, even if cash isn't immediately going out the door.
I see.
With high-growth companies like this, the market often tolerates it because they need to reward and retain top engineering talent with stock.
So the goal is to just outgrow it.
The goal is to scale so fast that your operational cash generation, the EBITDA, eventually just overwhelms those SBC costs. Then you hit GAAP profitability.
And we saw stability in that adjusted figure recently, too. Q4 of fiscal 25, adjusted EBITDA held steady at $49 million.
Correct. But if we look at the bottom line, they reported a net loss of $19 million in that same quarter.
Okay, still a loss, but the key takeaway is the direction, right?
Exactly. It's an improvement over the $28 million net loss from the prior year's quarter. This shows margin recovery.
Which suggests operational leverage is finally kicking in. As they deploy more systems, standardize the process, margins should expand.
That is the path. And management is guiding for stable gross margins in fiscal 25. That signals confidence in their cost control and their execution.
So the market is watching that $19 million gap very closely.
Very closely.
But scaling up operations like this takes a lot of capital. If they're still running a gap loss, are they reliant on debt?
And this is where the balance sheet becomes, well, a fortress. They ended Q4 of fiscal 24 with $727 million in cash and equivalents.
That's a lot of dry powder.
It's a massive war chest. It gives them tremendous flexibility for R&D, acquisitions, or just navigating any market volatility without needing to tap the capital markets.
That cash position is impressive. But what about the quality of the revenue they're bringing in? I noticed this huge figure for something called the contract liability balance.
Ah,
It
yes.
sounds like a debt, but it's treated as high-quality revenue. Can you break that down? What is that $567.9 million figure?
That is a fantastic and crucial question. It is a bit counterintuitive. A contract liability is essentially revenue that's been collected but not yet officially earned.
So like a down payment.
A massive down payment. Think of it like a customer prepaying for a huge custom machine that will take, say, 18 months to build and install.
The customer's already paid them.
Exactly. And when you see that they recognized $567.9 million of that balance as revenue over 9 months, it tells you that over $500 million of their future revenue is already locked in.
Wow,
It's revenue visibility with a guarantee attached.
that's incredibly powerful. It just proves customer commitment and takes a lot of risk off the table.
It does.
And if customers are willing to prepay that much, it must tie into their competitive edge, their moat. Why can't a giant just build their own system?
The moat is incredibly deep. It's built on, I'd say, 3 interacting elements. First is the proprietary tech itself, the specific AI and robotics they've fine-tuned.
So it's not just a robot off the shelf.
Not at all. It's a uniquely integrated, intelligent ecosystem. And the second pillar, the implementation, that creates the switching costs.
Right. Once this colossal robotic system is inside your main distribution center, replacing it would be.
Operationally devastating. It's essentially prohibitive. Imagine ripping out the entire operating system of a fully functional factory. The cost, the disruption, it makes the initial investment look tiny.
It creates an incredibly sticky customer base. They are locked in for decades.
And that scale and integration capability is a massive differentiator in itself.
Okay, so this brings us from hard assets to data, which is usually the most fascinating part of these tech stories. The network effect.
This is the real secret sauce, the virtuous cycle. Every time a Symbotic system is deployed, it generates proprietary granular data.
On everything.
Inventory movement, optimization routes, efficiency gains, failure points, all specific to that supply chain environment.
And what happens to that data?
It feeds directly back into their core AI models. This improves the platform's intelligence for all future deployments,
So better AI leads to better outcomes for the customer.
which reinforces their loyalty, increases switching costs, which in turn generates more proprietary data. It's a self-reinforcing loop that new competitors simply cannot access.
So every new system makes the entire platform exponentially smarter. A new competitor would have to start from zero. No data. It's almost impossible to catch up.
It is, and you can't ignore their first-mover advantage at this scale. When you're executing at nearly $2 billion in annual revenue, you demonstrate a capability to manage these huge, complex projects that, frankly, very few startups could even dream of matching.
Okay, let's shift gears to market sentiment, because we have to address the elephant in the room that has clouded this story, the regulatory overhang.
Right.
And it seems that's recently been resolved.
This is maybe the biggest positive catalyst for the stock in the near term. The company had this overhang tied to a prior restatement.
Which would naturally make institutional investors nervous.
Exactly. It restricted some buying. The removal of that uncertainty is a game changer.
And the details are clear. The SEC concluded its investigation on August 7th, 2025. They explicitly said they do not intend to recommend an enforcement action.
Which is a massive relief. It allows those big institutional investors to shift their focus right back to the strong fundamentals we've been discussing.
The growth rates, the cash, the defensible moat.
The decks are officially cleared for a full valuation based on performance.
And then adding to that, you had the appointment of Andrew Ross to the board on August 26th. That sends another signal to the market, doesn't it?
It does. It signals that management is serious about strengthening governance and compliance, which bolsters institutional confidence.
Okay. So, despite all these bullish points, a balanced analysis means we have to vet the risks.
Of course, no growth story at this scale is without challenges. The first major one is revenue concentration.
Right. With contracts this big, they're likely working with just a handful of the world's largest retailers and logistics firms. If one of those giants pulls back or delays a deployment, the impact could be material and sudden.
That is a legitimate concern. But remember that key mitigation factor we just talked about.
The contract liability balance.
That $567.9 million, that figure acts as a cushion because it proves those few massive customers have already made significant financial commitments. They're locked into long-term partnerships.
It mitigates the risk of a sudden pullback. Okay. And the second risk is the execution needed to get from adjusted EBITDA to actual GAAP net income.
Yes, that $19 million net loss we mentioned.
That's the critical execution challenge.
Yeah.
They have to maintain and accelerate margin expansion if their costs don't scale downward relative to revenue.
Or if SBC costs remain high, it will just take them longer to cross that threshold into GAAP profitability.
And if they delay that transition, the market might re-rate the stock,
Yeah.
value them more conservatively.
Exactly. Investors are patient, but not indefinitely. They have to prove that operational leverage is real and sustainable. But overall, when you step back and look at the whole picture,
Clean execution, accelerating revenue.
a fortress balance sheet, a defensible moat, and a market with huge tailwinds, the bullish narrative is really powerful.
It really seems like the combination of proprietary AI, the physical hardware, and that data feedback loop has created a nearly insurmountable barrier to entry here.
I think so. They've moved past the early installation phase and are now scaling into a major multi-year compounding growth story. This is a company positioned to redefine logistics for the next decade.
And the removal of that regulatory cloud just means the spotlight can finally shine fully on their operational excellence.
It's clear that the high-growth opportunity in AI-enabled automation is just beginning to unfold, and the clarity on the financial and regulatory front makes this an exceptionally compelling analysis.
If you found this talk useful and want to stay informed on the major catalysts driving the markets, please subscribe to Smart Wealth with Joshua again.